Okay, let's delve deeper into this. Imagine for a moment a kind of secret society within the world of high finance, a place where truly staggering fortunes are being cultivated before companies even make their grand entrance onto the public stock market.
Right, like an exclusive club.
Exactly. It holds all the allure and, wild promise of an early gold rush, yet it's equally riddled with serious, often hidden dangers. This isn't the everyday stock market you might be familiar with. We're talking about something known as the gray market, and right now it is particularly electrifying in the rapidly evolving landscape of artificial intelligence.
It really is buzzing.
So today we're taking a deep dive into this opaque yet potentially incredibly lucrative financial frontier surrounding these cutting-edge AI companies. And our understanding of this complex world, well, it's been significantly shaped by immersing ourselves in the fascinating discussions from Muki Tenenbaum and Claudio Suchavicki. They brilliantly illuminate the intricate contours of this evolving financial phenomenon.
Yeah, their insights are invaluable here. And one of those compelling aspects, I think, is how dramatically the dynamics are shifting, especially with AI. Historically, the aspiration for most companies was, well, to rush towards an initial public offering, an IPO. They were eager to unlock liquidity, get capital.
That was the dream, wasn't it? Go public.
It absolutely was. But with the current generation of AI giants, we're observing something different, a deliberate, strategic delay in going public. And this isn't accidental. It's creating unique, often phenomenal, opportunities, but critically, it's also generating equally unique and substantial risks for investors who are keen to get in early.
So understanding why that delay is happening is key.
Exactly. Our goal for you today is to thoroughly understand why these AI innovators are choosing to remain private for extended periods, how you might potentially access these investments, and perhaps most importantly, what pitfalls you absolutely need to be acutely aware of before you even think about venturing into this space. And this prompts a critical question, really. In a market moving at such breakneck speed, with valuations soaring, I mean truly soaring, how do we confidently discern genuine sustainable opportunity from what might just be, speculative froth?
That's the billion-dollar question, isn't it? Or maybe $1 trillion now. So to properly analyze this, let's start at the beginning. What exactly is this gray market? When we refer to the gray market, or mercado gris as it's often called in capital markets, we're basically defining the phase before a company's shares are publicly listed and traded on a major exchange.
Right, before the big IPO day.
Precisely. It's a period where private shares, typically held by founders, early employees, venture capitalists, other private investors, can be bought and sold. Now, this concept isn't entirely new to capital markets. It's always existed to some degree for private companies.
Sure, there have always been secondary markets for private shares, but maybe not on this scale.
Exactly. Its scale and intensity in the AI sector today are quite unprecedented. And this market functions as a crucial bridge, really. A period where existing investors can maybe get on or off an investment, as they say, before the final public offering. For early backers, it provides a vital avenue to realize some liquidity, some potential gains. While for new, ambitious investors, it offers a chance to jump into these high-growth companies before they become accessible to the wider public, often at a much higher price.
So it serves both sides, in theory.
In theory, yes. It's a space where valuations are set by private transactions, often far from the public eye and, crucially, public scrutiny.
And placing this in broader context, this whole AI anomaly we're seeing, it stands in stark contrast to historical trends in corporate finance, doesn't it?
Absolutely. You mentioned before companies used to rush to IPO.
They really did. In decades past, companies, along with their stakeholders, employees, angel investors, even contractors, paid in stock. They eagerly pushed for an IPO. Tenenbaum vividly recounts his own experience as a director in a robotics company back in the 80s. He said the entire corporate culture revolved around one question: when are we going public?
Everyone wanted that payday.
Desperate for that liquidity event, the moment their paper shares could finally become actual cash. He even mentioned this typical lockdown period post-IPO, maybe 6 months.
Where insiders couldn't sell.
Right. And almost predictably, he said, right after that period expired, the stock would often, well, collapse was his word, as a flood of early investors rushed to cash out.
Okay, so that was the old playbook.
Completely.
Yeah.
But with the unprecedented, almost fantastical growth of AI companies recently, the script has totally flipped. The valuations in AI aren't just growing, they're exploding monstrously. So accelerated that these companies now want to postpone their IPOs for as long as possible.
No, just to let the value climb even higher.
Precisely. They simply don't want to miss out on the escalating compounding value. Tenenbaum frames this quite insightfully, I think. Not as simple greed, but as ambition.
Ambition. Okay.
A strategic, calculated desire to maximize the company's value for its current stakeholders. I mean, why go public now at, say, $1 billion if, by staying private just another 6 months, you could potentially command a $5 billion valuation?
When you put it like that.
It makes sense from their perspective. But this prolonged pre-IPO phase, driven by these astronomical growth projections, naturally causes the gray market to swell. It gets bigger, busier. And as Tenenbaum warns, these gray markets, because they lack the transparency and regulation of public exchanges, can quickly evolve. They can become dark gray or even black markets, drastically increasing both the opacity and, crucially, the inherent risks for any investor looking to get involved.
Wow, dark gray or black markets. That sounds ominous. And it's such a profound shift in strategy and psychology. You highlighted how in the past you had this broad pressure for an IPO from lots of different people with shares. Tenenbaum and Suchaviki talked about stories like the famous one about Facebook's painter, right? Paid in stock, eagerly waiting for the IPO.
Yeah, that story really illustrates the point. There was this broad collective push for liquidity from many angles within the company's ecosystem.
But what we're seeing now feels different, more concentrated.
It does. The current dynamic seems more focused on the few key owners, founders, core investors. They're primarily focused on maximizing their ultimate sale price, delaying the IPO to ride that massive valuation wave.
But Tenenbaum also made a really crucial point about the employees, didn't he? Even the top AI talent today.
Yes, absolutely critical. He pointed out that today's top AI employees aren't just talented, they are incredibly ambitious and command exceptionally high valuations themselves. We're talking about figures where individual engineers or researchers might be valued, personally, in the realm of $1 billion, maybe even $1.6 billion.
That's just staggering for an employee.
It is. And these individuals, they often lack that deep-seated corporate loyalty you saw in past generations. They still want liquidity, they still want wealth growth, even if they're technically held by stock options promising future riches. So this creates a different kind of internal tension. While founders might want to hold on longer, these highly valued, indispensable employees also want to see their wealth become more accessible sooner rather than later.
Ah, so it's not just the owners driving the delay, but also managing the expectations of this super valuable talent pool.
Exactly. This unique dynamic where both the primary owners and the crucial high-value talent have these strong incentives tied to valuation and liquidity timing. Well, that's a major force fueling the expansion and the specific characteristics of this modern AI gray market. It's a very complex interplay of ambition, retention strategies, and precise timing.
Okay, so to really get a handle on the scale of this strategy, this IPO delay and the private valuation explosion, maybe we need a concrete example.
Yes, let's anchor ourselves. Consider Anthropic. Tenenbaum identifies them as one of the big 4 or 5 foundational AI players. They developed Claude, a major competitor to OpenAI's ChatGPT.
Right, I've heard of Claude.
So it leads us to ask, how do we even begin to comprehend a company growing at this kind of pace? The numbers are just, well, staggering. Anthropic is a company that's only, 2 or 3 years old? Yet it was recently valued in private funding rounds at almost $200 billion, specifically $188 billion.
Wait, $188 billion for a 3-year-old private company.
Exactly. To put that in perspective, that valuation is now greater than the entire market capitalization of a giant like Ford.
Yeah.
And Anthropic hasn't even gone public.
That's hard to process, more than Ford. Wow.
Their strategic bet on continued exponential growth, fueled by relentless AI innovation, has paid off incredibly well so far. By choosing to stay private, they allow their value to compound significantly before even thinking about a public offering. Or maybe they'll decide against one indefinitely, who knows?
So they just keep riding that private valuation wave upwards.
Precisely. It's a powerful testament to the belief among its founders and core investors that this exponential growth in AI valuations isn't just a blip, it's a sustained phenomenon. They believe it will continue to richly reward those who can patiently wait, maximizing their return by delaying public scrutiny and, premature liquidity.
It allows them to focus purely on the tech and the market, not shareholder calls.
Exactly. Development, market capture, beating competitors without the pressure of quarterly earnings reports and all the demands of the public market.
Okay, that Anthropic valuation really hammers home the massive potential value locked up in these private AI firms. But thinking about investing, whether it's public stock or a private share, there's always an underlying story you're buying into, isn't there?
That's a great point. As Suchaviki astutely observed, when you acquire stock, You're not just buying a piece of a company, you're buying its story, its future vision. And for investors, especially when looking at an IPO or a private share deal, a really critical question should always be, what will the seller do with the money they get?
Right, where's the cash actually going?
Exactly. This gets to the heart of that crucial cash out versus reinvestment debate Tenenbaum highlighted. If the existing owners are largely doing a cash out, selling a big chunk of their shares to retire, to diversify, just take money off the table, that often sends a strong signal.
A signal that maybe they think the peak is near.
It can suggest exactly that they believe the company is at or near its peak valuation, and they're de-risking. Tenenbaum observed, historically, that IPOs with heady insider cash outs almost predictably led to poor post-IPO performance for new public investors, often within the first year. The initial hype evaporates once the smart money has headed for the exits.
Okay, and the alternative.
The alternative is if the funds raised from the offering are largely reinvested back into the company. For R&D, expansion, maybe buying other companies. That signals deep, ongoing faith in future growth. It tells you the sellers believe there's still substantial upside to come.
That makes sense. So how do you find this information out?
Well, for public offerings, this kind of crucial information, use of funds, financials, strategy, risks, it's rigorously detailed in a document called the Red Herring Prospectus. That's the initial filing before an IPO, designed for transparency.
Ah, the red herring. Okay.
But the vital point for the gray market is this mandated, rigorous disclosure. It's largely, it's not entirely, absent.
So you're flying blind, essentially.
Pretty much. Investors in the gray market are essentially buying a story without the comprehensive supporting facts, the audited figures, the detailed risk assessments that a red herring provides. It makes informed due diligence incredibly difficult, sometimes impossible.
Which brings us back to that opacity Tenenbaum warned about.
Precisely. And it's particularly striking how the sheer power of secrecy plays such a pivotal role in the AI sector's strategy right now. Public companies, legally, have to report vast amounts of information constantly. Financials, executive pay, board structures, even ESG impacts.
Right, the quarterly reports, the filing.
Exactly. And that level of transparency, while essential for public trust, can actually be a significant competitive disadvantage in this fierce breakneck race for AI talent, proprietary models, and market dominance.
How so?
While private companies, in sharp contrast, enjoy the luxury of giving out very limited information to the public or even to many of their own private shareholders. This ability to withhold strategic information, protect intellectual property, keep competitors guessing, hide potential weaknesses, it's a major competitive benefit.
Keep your cards close to your chest.
Exactly. And when we consider the bigger picture, there's also what Tenenbaum and Suchevicki described as a significant legal disarbitrage at play.
Disarbitrage, what's that?
Think of it this way. Public companies in major markets like the US and Europe face strict regulatory burdens. Not just extensive financial reporting like Sarbanes-Oxley, but also increasingly demanding environmental, social, and governance standards, ESG.
Okay, a lot of compliance hurdles.
Huge hurdles. These formal economic and social demands are largely sidestepped by private companies. And this regulatory burden adds another powerful incentive to stay private as long as possible. It lets these AI innovators focus their resources purely on aggressive development, rapid iteration, intense competition.
Instead of spending time and money on compliance and public relations.
Exactly. So this fundamental information asymmetry, this imbalance of knowledge, is really a defining characteristic and arguably a core strategic advantage within the AI gray market, for better or worse.
Okay, that makes a lot of sense from the company's perspective. Less scrutiny, fewer hurdles, move faster. But for the market's health, and especially for investors like you listening, doesn't this lack of transparency also breed the perfect environment for those risks Tenenbaum and Suchevicki warned about? The opacity, the potential for things to go wrong?
That's the inherent tension, isn't it? The competitive edge gained through secrecy versus the investor risk created by that same secrecy. There isn't really a strong counter-argument presented that favors immediate public oversight in this hyper-competitive phase. The drive to innovate and capture the market seems paramount for now.
So the competitive edge seems to be winning out, at least for the time being. But shifting gears slightly, Suchevicki brought up an even more fundamental question, didn't he? Something that changes the perspective on wealth itself.
He did, yeah. The shadow cast by the dollar. He put it quite directly. We're talking millions and billions of dollars here. But what if the dollar itself is constantly depreciating in real terms?
Losing purchasing power over time.
Exactly. He illustrated it with a thought experiment, suggesting you could ask an AI, like ChatGPT, to compare the S&P 500's performance when divided by Bitcoin, or divided by gold, or even the value of prime real estate divided by gold.
And what did he say the results show?
He noted they often highlight that traditional fiat currencies, like the dollar, are arguably at historic lows against these alternative, perhaps more tangible assets.
Which leads to a big question for sellers.
Right. Why capitalize your incredible wealth and future potential in a currency that many perceive as losing ground, especially if you think that trend will continue? In this climate, a growing number of savvy investors, particularly in the high-stakes gray market, strongly prefer holding assets they consider real.
Assets whose value isn't just tied to government policy.
Precisely. Over dollars, which can feel like a depreciating paper currency. And this feeling, this sentiment, significantly fuels the desire for private company owners to hold on to their valuable shares even longer. They see the shares themselves as a potentially superior store of wealth compared to cash.
Okay, so that preference for real assets over potentially depreciating dollars adds another layer to why they stay private. But this discussion about the dollar then led to a deeper debate, right?
Yeah.
About what even is a real asset.
It did, and it's a fascinating philosophical detour almost. Tenenbaum, with his usual candor, admitted he still struggles to fully grasp Bitcoin's fundamental value proposition. He questioned whether its main defining quality, scarcity, truly makes it an ultimate store of value.
So he's skeptical about Bitcoin itself.
He expressed personal skepticism.
Yeah.
Viewing it from his perspective, maybe more as a complex financial instrument, appealing perhaps to a specialized group, rather than a universally understood fundamental store of value. He was careful, though, clarifying it wasn't investment advice, just his personal take.
Got it. But he did see value in the underlying tech.
Immediately. Despite his crypto skepticism, he acknowledged the marvelous blockchain technology behind Bitcoin as highly relevant, potentially transformative. He thinks this distributed ledger tech has immense implications, even for the gray market's own mechanisms, which we'll get to with things like tokenization.
Okay, interesting distinction. Tech, yes. Currency, maybe not.
And this brings us right back to that paper asset debate. Is a share of stock truly a real asset? Or is it just a piece of paper or a digital entry representing ownership in what's ultimately a fictitious entity, a legal construct like a corporation?
Compared to something tangible, like a house.
Right. He conceded that a house, while also represented by paper, a deed, is tangible. You can physically occupy it, live in it, rent it out. It has this immediate physical utility, a perceived reality. It highlights the abstract nature of corporate ownership.
So the incentive is holding a share in a company that's actually innovating, creating real-world value that feels more real than holding potentially appreciating cash.
Exactly. If you believe the company's underlying value is increasing faster than the currency's purchasing power is eroding, holding that share becomes incredibly compelling. And that belief really underpins so much of the gray market's current dynamic.
Okay, so we've clearly established why these AI giants are staying private longer and the intense demand this creates. But this leads to the really practical question for you, our listeners. How can you even begin to get in on this action? Let's break this down. If you can't realistically wait for an IPO, and everyone seems to want a piece of this explosive AI growth, what are the actual ways to invest in these pre-public giants like OpenAI or Anthropic?
Well, there are some direct methods, but, and this is a big but, they are typically not accessible to individual retail investors like you and me.
Okay, good preface. Like what?
For instance, employees at these top-tier AI companies, say OpenAI, they often have specific windows, designated periods when they're allowed to sell a portion of their vested shares.
Right, employees getting some liquidity.
Exactly. And these private transactions often happen at absolutely mind-boggling valuations. Tenenbaum mentioned OpenAI being valued at $500 billion in some of these private dealings.
$500 billion? Privately?
That was the figure mentioned. But here's the crucial catch. These sales are almost exclusively structured for large institutional funds, sovereign wealth funds, or extremely sophisticated high-net-worth investors. They are not designed for you or me to just buy a few shares directly.
So a huge barrier to entry for regular investors.
A massive barrier, which forces the market to get creative, leading to more complex and often much riskier structures to try and facilitate broader participation.
Which brings us to
a really compelling aspect, the rise of these increasingly complex investment vehicles, designed precisely to bridge that gap between eager investors and those elusive private shares. But, and this is a critical warning we need to keep repeating, with these vehicles come significant, often hidden, dangers.
Okay, what kind of vehicles are we talking about?
The most common, the most widely used right now, are special purpose vehicles, or SPVs.
SPV, okay, what are they?
An SPV basically is a company whose only asset is shares in another private company, like OpenAI or Anthropic.
Hmm.
Think of it like a specialized holding company, a box. And inside that box, there are only shares of one specific private company.
So how does it work for an investor?
Well, an early employee or investor wants liquidity, right?
Mm.
So they sell their OpenAI shares into this SPV box. Then the SPV itself issues its own shares, usually private shares, to investors like you.
So I buy shares of the SPV, not directly of OpenAI.
Exactly. You become a shareholder of the SPV, which in turn holds a piece of the underlying AI company. It allows for fractional ownership and some kind of secondary trading of these private company interests.
Okay, that sounds like a workaround, but you mentioned risks.
Huge risks. When we look at the bigger picture, this is precisely where it gets incredibly intricate and profoundly risky. There's a severe danger of outright fraud. Tenenbaum vividly recalled cases where companies set up as SPVs claimed to hold underlying shares they simply didn't possess. This led to massive scandals, hundreds of millions of dollars lost.
Yeah, we're selling shares of an empty box.
Essentially, yes.
Yeah.
This layering of financial products, one on top of another, this is what we mean by securitization of securitization. It creates immense opacity. It makes it incredible.
That's not a comforting comparison. You mentioned ETFs earlier, exchange-traded funds. How do they compare? Are there ETFs for these private companies?
That's a good question. Many people are familiar with regulated ETFs. They're funds supervised by government entities, providing a relatively safer, diversified way to invest in sectors or baskets of companies like a tech ETF.
Right, they feel safer, more transparent.
They generally are, due to regulation. But the crucial distinction for the gray market is that true regulated ETFs for private companies, they don't really exist in the same way. However, similar concepts are often adapted, but crucially, without the same level of regulatory oversight.
So kind of like an ETS, but without the safety net.
That's a fair way to put it.
Yeah.
Claudio Suchovicki gave a pertinent example with crypto ETFs. Even for something volatile like crypto, investing via a regulated ETF offers a layer of protection against lost keys, platform failures, things like that. That essential regulatory oversight and investor protection is precisely what's largely absent, or much weaker, in the gray market SPV structure. It leaves investors far more exposed.
Okay, so SPVs sound like a complex workaround with significant hidden risks, especially that securitization of securitization danger. And now, things get even more interesting. You mentioned tokenization.
Yes, here's where it gets really cutting edge, perhaps. Beyond SPVs, there's increasing talk and some actual attempts at tokenizing actions.
Tokenizing, like using crypto tokens.
Essentially, yes. Leveraging blockchain technology to create something akin to crypto tokens that represent shares or even fractions of shares in these highly sought-after pre-IPO companies. It adds yet another layer of digital abstraction and technological complexity to an already opaque structure.
So moving even further away from directly owning the share.
Exactly. And it's particularly striking that the further you move away from the straightforward act of buying a share directly on a regulated public exchange, the more your risks just multiply. Geometrically, almost.
Okay.
Tokenization adds another layer of abstraction, introduces new potential points of failure, new vectors for fraud, especially if the underlying claims about the shares supposedly backing these tokens are false, unverified, or just difficult to audit.
Okay, so if the risks keep escalating with these layers, SPVs, tokenization, why are people still jumping in?
It prompts that critical question, doesn't it?
Yeah.
Given these escalating risks, why the eagerness? The answer, quite frankly, often boils down to desperation and the incredibly powerful grip of FOMO.
Fear of missing out.
The fear of missing out. People are so desperate, so afraid of missing this perceived AI gold rush that they are actively paying a significant premium. Tenenbaum mentioned sometimes as much as 50% more than the company's actual independently assessed valuation just to acquire these shares today.
Paying 50% over the odds just to get in now. Wow.
They're willing to overpay significantly for the promise, the hope of massive future gains. And Tenenbaum highlights another crucial timeless point here that every investor needs to tattoo on their brain. Always be aware of your financial advisors or broker's incentives.
Right, how do they get paid?
Exactly. Your broker earns commissions every time you buy and sell. They are, fundamentally, like that salesperson at the appliance store Tenenbaum mentioned. Their primary interest is making the sale, closing the deal, not necessarily your long-term financial health or whether this specific investment is right for you.
They make money when you trade.
Precisely. And this practice, if done excessively just to generate fees, has a name: churning. They might encourage frequent trading, regardless of market conditions, because each transaction lines their pockets.
Something to be very wary of. Well, what about the seller's perspective in this gray market?
That's the other side of the coin, equally important. The person or entity selling these pre-IPO shares, they're not fools. They're generally sophisticated players. They're likely selling for a reason.
And that reason might be.
It often includes a belief that the price is peaking, or might even decline soon. Meanwhile, you, the buyer, are acquiring them precisely because you believe the opposite, the price will go up.
So there's this fundamental disagreement about future value baked into the transaction.
Absolutely. This fundamental, often opposing dynamic between buyer and seller should always be front and center in your mind. If someone is eagerly offering you a piece of what they claim is the next big thing, the secret path to riches, there's usually a very good strategic reason why they're willing to part with it right now. Understanding those potential motivations is absolutely paramount before you jump in.
That's a stark but really essential reminder about who truly benefits in these high-stakes, often opaque transactions. Let's break this down even further. When we talk about this securitization of securitization, these layers upon layers of complex financial products, it really does bring to mind those unsettling parallels with the 2008-2009 subprime mortgage crisis.
It really does. Tenenbaum and Suchovicki touched on how this kind of intricate layering can dangerously obscure the true underlying risk. They recalled how it contributed to one of the biggest economic calamities in the last century.
And if you, listening, genuinely want to understand how that happened, the mechanics of systemic financial risk, how institutions pushed toxic products, I honestly can't recommend enough watching films like The Big Short or Inside Job.
They are incredibly educational, aren't they? They really drive home the importance of empirical due diligence, actually going out, questioning, looking at what you're investing in, rather than just blindly trusting the fancy repackaging or the salesperson's pitch.
Yeah, don't just trust the label on the box. And even today, the market offers these complex synthetic investments, right? Things with guaranteed capital but conditional returns.
Exactly. You might be offered a product that promises, say, if gold goes up 10%, you win, and if silver goes down 5%, you don't lose, and 80% of your capital is secured. They sound complex and maybe safe.
But they're hard to fully understand.
They're incredibly sophisticated financial engineering marvels. And while not inherently malicious, they can make it extraordinarily difficult for an average investor to truly grasp the intricate web of conditions, the actual level of risk exposure, and how different market scenarios would truly impact their final return. This complexity is precisely what the gray market thrives on, potentially leaving investors vulnerable to hidden risks they never even knew they were taking.
Which circles back to that core issue of opacity and risk. And you mentioned FOMO earlier.
Yes, and it's particularly striking just how much investment decisions in these hot markets are driven by that powerful emotional force. FOMO, the profound fear of missing out on a massive, life-changing opportunity. As Tenenbaum repeatedly points out, this psychological trap is arguably one of the single biggest reasons why people ultimately lose money, especially in a fast-moving, high-stakes, and information-scarce environment like the AI gray market. The allure of being part of the next big thing, getting in early, it can completely override rational judgment.
You get caught up in the hype.
Totally. And when we consider the broader picture, there's also that immense valuation challenge we touched on. How do you, as an individual investor, how do most institutional investors genuinely and accurately value a private company like OpenAI at, say, $500 billion?
What numbers are you even using? Where do they come from?
Exactly. What methodologies? How do you arrive at such a colossal calculation without public financials, without independent analyst reports, without transparent market comparables? It's incredibly difficult, even for the most sophisticated financial minds, let alone someone navigating a murky gray market with severely limited information.
So the valuation itself is almost an act of faith sometimes.
It can feel that way. Which leads us to ask a vital question, and Tenenbaum used this brilliant analogy.
Right.
Think about buying a timeshare.
The timeshare pitch. I know where this is going.
Right. You're often swept away buying a dream while you're in a hot, emotionally charged state. You're caught up in the promise of future vacations, the glossy brochures.
High-pressure sales environment.
Exactly. And that's precisely why, in many places like the U.S. or Europe, consumer protection laws give you a 72-hour, maybe even a 1-week cooling off period, a legal window where you can retract your purchase without penalty.
Because they know people make impulsive decisions under pressure.
Precisely. This protection exists specifically because these are high-pressure, emotionally charged sales environments designed to capitalize on impulsivity. Now, here's the critical point. This kind of protective cooling-off period simply does not exist for these SPVs or other gray market AI investments.
No buyer's remorse clause.
None. Once you buy it, you own it. And there's often no liquid secondary market to easily sell it if you change your mind or get cold feet. You're forced into making these hot decisions that you might later deeply regret. And Tenenbaum mentioned this vertiginosity, this dizzying speed of rapid price changes and high-pressure tactics in an illiquid market. It just amplifies the pressure on investors to make quick, potentially ill-advised moves.
Yeah.
You feel like you have to act now.
That combination of hype, opacity, and pressure sounds incredibly dangerous. And there was one more trap you mentioned. The AI label trap.
Yes, and this one is pervasive and incredibly dangerous right now.
Yeah.
Many companies, knowing the magnetic pull of the term AI, are slapping that label on themselves. But upon closer inspection, they often lack genuine substance, proprietary technology, or a truly sustainable competitive future.
Like .com in the .com bubble.
Exactly like that. Today, AI has a similar, almost magical magnetic pull. But for a private company, how can you as an investor independently verify if their AI is genuinely innovative? Is it truly proprietary or fundamentally defensible against bigger competitors?
Is it real AI or just AI washing?
Precisely. Is it a groundbreaking large language model they built from scratch, or just a thin wrapper of machine learning over existing software? Maybe even just using publicly available APIs from the big players. Remember, the established tech giants Google, Microsoft, Amazon, Meta, they possess vast resources, colossal data sets, seemingly endless pools of top talent. They can often quickly replicate a smaller AI company's features or even acquire them for a fraction of their inflated private market valuation if they pose even a minor threat.
So the little guys might just get crushed or absorbed.
It's a very real risk. For an investor, without the benefit of public disclosures, audited financials, expert analyst reports, distinguishing between a truly groundbreaking AI innovator and a company just leveraging the AI hype to inflate its valuation is incredibly challenging. It turns this segment of the market into a veritable minefield for the uninformed. Tenenbaum stresses this point. It's crucial to understand that many, if not most, AI companies, while perhaps legitimate in their efforts, simply might not have a viable long-term future because the big players will inevitably outcompete, absorb, or render their innovations obsolete.
Wow. Okay, that's a profound set of challenges and psychological traps. It really paints a picture of a very treacherous landscape. So if our own human emotions, our biases, the sheer complexity of these markets can so easily cloud our judgment, is there any way to seek a truly objective perspective? And this leads us to a really interesting, almost meta question. Could we actually turn to artificial intelligence itself for unbiased investment advice on AI companies? Tenenbaum playfully suggested asking an AI like ChatGPT, right?
He did, and it's particularly striking because an AI, like ChatGPT, operates without emotions. It doesn't have biases in the human sense, no personal financial incentives, which can indeed be a significant advantage when you're seeking objective analysis.
Take the emotion out of it.
Exactly. But this immediately prompts a critical question. Where does the AI actually get its data from?
Garbage in, garbage out.
Potentially. If the input data feeding the AI has inherent biases, maybe it's scraped from news articles that are overly optimistic or financial reports that lack context, or if it relies solely on publicly available information, which, as we've established, is severely limited for private companies in the gray market.
Yeah.
Then the AI's output, despite its unemotional delivery, might inherently reflect those same biases or significant data gaps. That's a crucial consideration.
So the AI is only as good as the data it's trained on, which might be flawed or incomplete, especially here.
Precisely. So Tenenbaum's practical advice, especially if you're considering a significant investment, is maybe to engage multiple AIs. Ask 2 or 3 different ones the same questions, compare their responses.
Triangulate the AI advice.
Sort of, yeah.
Yeah.
If they all provide broadly similar answers, it might increase your confidence, maybe in the consistency of the underlying public data they're accessing. Or at least it could highlight areas of strong consensus versus areas where even the AIs seem uncertain or contradictory. It's a method of cross-referencing, leveraging the AI's dispassionate approach, but still applying human critical thinking to the outputs.
That makes sense. Don't just trust one source, even if it's an AI.
Definitely not. And ultimately, we have to remember the human cost Tenenbaum spoke about, making a poor investment decision. It's not just about the financial loss, is it? It's the crushing disappointment, the frustration, the regret, the self-reproach that follows. It's that double suffering, as he put it.
Yeah, beating yourself up afterwards.
Exactly. So the core message, the reason this deep dive felt so crucial is this. If someone approaches you, offer you an investment opportunity in the AI gray market, you absolutely must understand unequivocally that it is not free money or a guaranteed win. It comes with significant baggage. You absolutely need to educate yourself thoroughly, to learn, to become acutely aware of the inherent dangers, the layers of complexity, the very real potential for misunderstanding or even outright fraud that often accompany these seemingly lucrative exclusive opportunities. Vigilance and informed skepticism are honestly your greatest assets here.
So wrapping this up then, what does this all mean for you listening? Our deep dive into the AI gray market, drawing heavily on those insights from Tenenbaum and Suchovicki, has really, I hope, peeled back the layers on what is a fascinating, undeniably exciting, but also undeniably high-stakes and risky financial landscape. Remember the key takeaways. This extraordinary, unprecedented growth in AI is driving companies to deliberately delay their IPOs. This creates these dark gray opportunities for early investors, yes. But hand in hand with those opportunities comes significant, often hidden risks.
Big risk.
Huge risks. The fundamental opaqueness of private companies where critical information is just scarce. The complex, sometimes potentially fraudulent investment vehicles like SPVs, and maybe even tokenization down the road. That powerful psychological trap of FOMO driving irrational decisions, and the sheer, almost impossible difficulty of truly valuing these hypergrowth entities without transparent data. It's a world where the old rules of public market investing are being rewritten, it feels like. But those fundamental, timeless risks, speculation, information asymmetry, getting caught in hype, they remain, and maybe they're even amplified in this environment.
I think that's exactly right. And when we consider the broader context, the rapid, almost dizzying evolution of AI innovation demands a new, maybe elevated level of financial literacy and critical thinking from investors like you. Knowledge is most valuable, isn't it? Not just when it's acquired, but when it's truly understood and thoughtfully applied. And in this specific market, that means digging deep, understanding the why and the how behind the staggering numbers, and being acutely, critically aware of where your hard-earned money is truly going far beyond the initial, often seductive promise of a quick, high return. So here's a final thought to leave you with. Given this unprecedented speed of AI innovation and these unique, sometimes experimental financial structures emerging around it, how might our fundamental understanding of company valuation itself, of market liquidity, maybe even the very nature of public versus private markets, how might all that continue to transform and evolve in the coming? And perhaps more critically, what entirely new, maybe currently unforeseen challenges might this rapid ongoing evolution pose for investors like you, seeking to participate intelligently and hopefully safely in what really promises to be the most significant technological revolution of our time?
A lot to think about indeed. Until next time, keep digging, keep learning, and definitely stay informed. Your financial future might just depend on it.